Hello everyone, I'm Oldfish. I wonder what percentage of your investment portfolio is allocated to Canadian assets. Personally, I plan to allocate 20% to 25%, mainly to diversify the risk exposure from US stocks. For this part, I'm already using Hamilton's HDIV to replace the broad Canadian index. But if I want to choose another ETF with higher dividends to boost cash flow, which one should I pick? In 2025, the market just launched 3 high-dividend ETFs focused on the Canadian market: ECHI, HHIC, and CANY. Their parameters are very similar. They all selected about 10 core Canadian blue-chip stocks. The covered call coverage cap is 50%, and the leverage ratio is between 25% and 33%. So which one should you buy? Today, let's analyze them. After watching this video, maybe you'll know where to put your money. By the way, since these 3 ETFs have a history of less than a year, currently ECHI is performing the best, followed by HHIC. But because their track records are too short and their basic parameters are basically the same, I will first analyze them based on their holdings. Let's get started right away. First, let's look at the first one, Evolve's CANY. Looking at the latest holdings chart, CANY is actually a highly concentrated portfolio of 10 stocks. Financials plus uranium plus pipelines plus a small amount of high-quality growth stocks. Look at its unique allocation. First is the extreme bet on the financial sector. Besides the familiar RBC and TD, it also bets on BMO and Scotiabank, plus Brookfield, the alternative asset management giant. Out of 10 stocks, there are 5 financial institutions directly. This is equivalent to placing the leverage directly on the event of interest rates falling and financial valuations repairing. Brookfield is a holding unique to CANY among the 3 funds. It benefits from long-term management fees from global infrastructure and alternative asset management. As long as market sentiment recovers, there is room for expansion in both management scale and valuation. In addition, CANY's resource exposure is chosen very conservatively. It only kept Cameco, a uranium producer, and Enbridge, a midstream pipeline company. It doesn't hold gold mines, nor upstream crude oil companies like Suncor or CNQ. CANY's holdings show a willingness to participate in the long-term story of nuclear power and energy infrastructure, but it tries to minimize direct bets on oil prices themselves. Additionally, CP Rail in the holdings bets on North American trade and logistics volume, while Thomson Reuters is linked to capital market activity information subscriptions. These are all beneficiaries of an economic soft landing. So to summarize, CANY is a high-yield portfolio that is light on resources and heavy on financials. It doesn't completely detach from commodities, but it excludes high-volatility assets like upstream oil and gas and gold mines. It prefers to use banks, asset management, railways, and high-quality growth stocks to capture the overall market trend brought by an economic recovery. If you judge that oil prices will fluctuate in the future but won't skyrocket, and the economy has a high probability of a soft landing, then CANY's configuration focused on financial recovery will have better upside potential. The second one is Ninepoint's ECHI. It's almost a mirror version of CANY. While CANY makes banks the protagonist, ECHI puts hard assets in the center stage. Let's see where it puts the money. First, look at the gold allocation. Barrick Gold is one of the world's largest gold mining companies. Its stock price follows the gold price very closely. It is a pure gold mine beta directly exposed to inflation expectations and geopolitical risks. In terms of energy allocation, Cameco is responsible for uranium. CNQ plus Suncor are typical upstream oil and gas producers. Enbridge is a midstream pipeline. Its allocation is completely different from CANY, which only keeps Enbridge. ECHI is equivalent to buying the entire energy industry chain. As long as the energy and resource cycle warms up, its elasticity will be very large. On the defensive side, it chose Canadian National Railway (CNR). Compared to CANY's CP, CNR's business structure is more stable. It transports a lot of commodities and necessities, belonging to the double bonus of a resource bull market plus daily logistics. As for banks, it has them, but they are just supporting roles. Although Royal Bank and TD are in the holdings, their weight is deliberately kept at around 7% to 8%, clearly supporting roles compared to resources. What really drives the net value is not banks, but the chain of hard assets: gold mines, uranium, and oil and gas. If you buy ECHI, you are betting on inflation plus a major resource cycle. CANY bets on money making money, interest rates falling, and financial valuation repair. ECHI bets on scarcity. If you are worried that the future will be a world of high inflation, geopolitical conflicts, and resource shortages, then ECHI's concentrated portfolio of hard assets will be more suitable. Let's look at Harvest's HHIC. From its investment portfolio, it seems to have bought a little bit of everything. The portfolio is relatively balanced. Let's look at the commonalities first. Like ECHI, it has heavy positions in gold mines and uranium. In terms of oil, gas, and electricity, it bought Enbridge, Suncor plus CNQ, paired with TD, Royal Bank, and Shopify. Basically, it hasn't missed out on resources or financials. This difference lies in gold. It chose Agnico Eagle. Its assets are mainly in places with relatively low political risk, so its volatility is smaller than Barrick, which fits Harvest's consistent prudent style. The real point of difference lies in the telecom sector. HHIC bought both BCE and TELUS. These two add up to nearly 15% of the position, which is the biggest bet on telecom among the three products. To make room for telecom, it directly gave up railways. That is to say, it believes that the valuation repair of telecom stocks offers better value for money than betting on economic recovery with railways. To summarize HHIC, it is not extremely biased towards financials like CANY, nor does it push banks to the corner like ECHI. Instead, it buys a little of every sector. If you believe that resources won't crash, Canadian big banks can hold steady, and the high dividends of telecom stocks are an opportunity rather than a trap, then HHIC might be your choice. We've talked about holdings, but there is actually a core question. Currently, CANY's annualized dividend yield is 20%, ECHI is about 16%, and HHIC is 14%. So, what impact do these dividends have on the prices of these three ETFs? We have to look at where this return comes from. The formula for this type of ETF is roughly total dividend equals underlying stock dividends plus premiums from selling covered calls plus leverage effect. The logic is simple. If the dividends of the underlying stocks are already high, the fund manager doesn't need to be aggressive in selling covered calls. Naturally, this leaves more room for upside. If the underlying dividends are low but they want to pay a high dividend, they can only rely on more aggressive option strategies and leverage. Let's do the math. First, let's look at HHIC. Although HHIC annualized dividend yield is only 14%, its structure is actually the most comfortable of the three. It holds double telecom stocks, BCE and TELUS. Both have dividend yields around 7% to 8%, plus Enbridge and bank stocks which also have decent dividends themselves. Therefore, underlying dividend yield of HHIC is relatively high to begin with, so it doesn't need to sell covered calls aggressively just for the dividend rate. In other words, relatively speaking, it can retain more room for stock price appreciation. This is also verified in Harvest's official disclosure documents. Most stocks haven't reached the 50% covered call coverage cap. Let's look at CANY. CANY's problem is more intuitive. Among its unique stocks, CP Rail's dividend yield is only 0.8%, and Brookfield is only 0.5%. Although there are a few banks supporting the bottom, overall, CANY's underlying dividend is the lowest tier among the three, and its holdings don't include upstream energy companies or gold mining companies, so volatility is also relatively low. But it needs to pay the highest dividend in the field, close to 20%. Where does this difference come from? We can infer that it likely requires more reliance. This means higher leverage and a more active covered call strategy. Therefore, we can reasonably infer that a significant part of CANY's ultra-high dividend is obtained by relying more on covered call premiums, cashing in future gains in advance to a certain extent. Finally, let's look at ECHI. ECHI is in a middle state. On one side, it has high-yield BCE and Enbridge. On the other side, it has a few stocks that pay almost no dividends but have high volatility, such as Barrick and Shopify. In addition, resource stocks have high volatility, and options themselves are valuable. So it can achieve about 16% dividend by writing moderate covered calls plus a little leverage. Finally, a reminder, the current annualized dividend yields of 14%, 16%, and 20% are calculated backwards based on the current ETF prices. The annualized dividend yield is not a promised interest rate like a bank deposit. The future dividend amount will be adjusted based on market volatility and the fund company's decisions. What really matters is not who has the bigger number now, but whether this return comes from a risk source that allows you to sleep at night. Let's summarize. CANY is more like an investment portfolio betting on financials plus a small amount of resources. For me, financial sector allocation of HDIV is already high, and the bank ETF bets even solely on the financial sector. So I won't consider buying CANY to increase my Canadian financial sector weighting. Holdings of HHIC are relatively balanced, and overall it can be considered. ECHI's core logic is hard assets first. If considering portfolio balance, I will likely add this one. Moreover, management fee of ECHI is also the lowest among the three ETFs, at just 0.29%. But I must emphasize here, this is just my own choice for this portfolio. It is not a standard answer and certainly not investment advice. In my opinion, for CANY, ECHI, and HHIC, it's not a question of who is better, but who is more suitable to help you fill a piece of the puzzle. So CANY, ECHI, HHIC, which one would you choose? Or would you simply choose none? Welcome to tell me your thoughts in the comments section. I am Oldfish. If you like this kind of content, don't forget to like and subscribe. See you next time.